Welcome to the Federal Retirement Podcast. My name is David Raetz from Benchmark Financial Group, and every month we discuss important topics regarding the retirement planning process for federal employees. This Lunch and Learn series is an interactive discussion where individuals can ask questions. To join these discussions live, you may register by joining our email list at bfgkc.com. We also provide in-person retirement planning and benefit education to federal employees. To learn more about these seminars or to schedule a seminar at your federal agency, go to our website at bfgkc.com and click on seminars. Additionally, if you're looking for assistance to get your retirement on the right track, set up an appointment with us today. You can schedule an appointment online by visiting our website at bfgkc.com or email me at david.raetz@bfgkc.com. The contact information is also listed in the description. By setting up a complimentary consultation, we can review your financial situation and develop a plan to meet your financial goals. We hope you enjoy this topic and hope to connect with you soon.
We're kind of brainstorming best topics to start the year with, and it seems like with all the chatter in the news about how AI is going to reshape the economy and geopolitical headaches that have been going on, it was a good time to just touch on some ideas and some topics about navigating market volatility with your TSP. So, like Patty said a second ago, feel free to chime in with any questions and we'll get going. Alrighty. So just 1,000 foot up refresher on the individual TSP funds. It's always good to just refresh your mind about the ins and outs of each of the individual five funds. So starting off with the safest funds, G Fund is definitely considered the safest fund. Interest is paid by the U.S. Treasury. You don't necessarily need to worry about it going down in value. It's not going to blow the socks off of growth to the plus side. So you always got to take that into consideration. But definitely the safest option out of the mix. F Fund is also considered one of the safer funds. But the thing about F is that the return in F ebbs and flows based off of the direction interest rates are going. So let's say you had a $100 bond that was paying 2%, and then they came out with $100 bonds that were paying 3%. If you're in that scenario, your $100 bond that was paying 2% is no longer worth $100. It's where they're going to discount it to like $98 or $96. So the differences in interest rate fluctuations have an impact on the value of F, especially when you're thinking about using it as a safer option. You just always want to be aware of where you're at with interest rates when you're making an investment with F. Moving on to the stock funds. C fund would generally be considered the total stock market fund or total U.S. stock market fund. It's an S&P 500 index fund, tracks the performance of a large swath of U.S. corporations. You got 100 very large corporations in there and 400 medium mid-cap companies. So there's a lot of money and a lot of people benchmark to the S&P 500. So it's a major index. So C Fund is kind of like number one on the stock list. But in addition to C Fund, there's also S and I. So just digging in a little bit about S, it tends to have higher highs and lower lows than C, for instance. Generally, when you're in a lower interest rate environment, that's advantageous for investments in S Fund because S Fund is small companies that are in growth phase. And when interest rates are low, it's cheaper for them to get financing to expand operations. So I always want to take that into consideration. And the last of the main stock funds would be the international fund, or I. Large, medium-sized international corporations, but a lot of them have a worldwide footprint. They're just headquartered outside of the United States. So I was just looking at top 10 holdings of the I fund. Taiwan Semiconductor is number one at the list. They're building a massive factory here domestically in Arizona. Toyota, AstraZeneca, Shell. So you got some large companies that just don't have their HQ in the United States. Is all. But you always have to be taking into consideration geopolitical concerns, currency fluctuations. Those have a big impact with return potential in I fund. Moving on from just 1,000 foot up view of the individual funds, just a refresher on the fact that each dollar that you put into the traditional side of TSP is reducing your current tax bill to Uncle Sam. So those dollars are all considered pre-tax. On the raw side of TSP, you're funding those with dollars that you've already paid taxes on. And the caveat is that if you check all the boxes, you'll be able to take the gain out tax-free after 59 and a half. So traditional is pre-tax, Roth is after tax, which makes an impact on how you use the money going forward as a retiree. Just a refresher on contribution limits for 2026. So base deferral for TSP contribution, 24,500 for 2026. And it's important to remember that if you don't forget about the catch-up contribution. So if you're in the category or you're age 50 to 59, 2026 catch-up contribution allows you to put an additional $8,000 in over and above the 24.5. If your age is, and this one's an important one too, because if you fall into the category where your age in this year, age 60 to 63, you get a slightly higher amount that you can put in for the catch up. So if you're anywhere between 60 and 63, you can put 11,250 in for a catch up contribution. And then from 64 plus, it reverts back to the normal catch up of $8,000. So, and those, one of the caveats there is that can go all on the traditional side, or it can all go onto the Roth side, or it can be a split of the two. So remember that one in the back of your mind going forward. And then don't forget about the life cycle funds. So now life cycle fund, the new ones that they added to the list for this year, 2075 would be the new one. So it stretches all the way from L income out to 2075 for life cycles. Digging a little bit deeper into the weeds, C-Fund tracks individual returns of the S500 SP or 500 mega cap US corporations. S Fund, like you said earlier, companies in the growth phase. So traditionally, a small cap company would be considered with a market capitalization or the value of their outstanding stock less than 2 billion. Medium mid cap companies are generally 2 to 10 billion, and then large cap would be 10 billion and over. But now we've entered territory where large cap has gotten big enough that they've added a new subcategory of large cap called mega cap, which that's where most of the technology companies fall into: Google, Facebook, Amazon, those type of companies. A little bit deeper into iFund. iFund tracks the MSCI Hong Kong International Index. It's a broad international market index made up of large, mid, and small companies. It's invested in more than 40 developed countries. So we're not swinging for the fences. Companies that are small, going public in China, for instance. These are larger corporations that have been around a while and just don't have their headquarters in the US. And like we said earlier, right now, geopolitical and currency risk are always a factor because the value of the dollar is fluctuating relative to the value of other currencies too. So keep that one in the back of your mind. Life cycle funds, this one's just a refresher on how life cycle funds work. It's important to remember with life cycle funds that they're a pie chart of GFCSI. So it's a diversified mix of the 5 individual funds. On a quarterly basis, they adjust that pie chart. But the further out the target date is, the riskier the life cycle fund. So this year's world 2075 would be considered the riskiest or the life cycle fund that has the most variability. And then the closer and closer that you get to the current date, they get more and more conservative. So L income is kind of a subcategory because that one's specifically designed to generate current income for retirees. But 2030 would be, for this year, the most conservative life cycle fund. And then it incrementally adds a little bit more risk the further and further out that you go. So some key questions to think about when you're thinking about navigating market volatility with TSP and going into the retirement planning process. An important one at the top of the list is, how soon do you plan to retire? Because that impacts how the money's going to be invested. I mean, if you're planning to retire in 5 to 10 years versus the next 2 years, you would presumably have a little bit more money in C fund as opposed to G fund. When do you expect to begin getting your TSP withdrawals? Sometimes people retire from the government and they plan to go start working on a contract basis, or they plan to just generate income off of pension and the first supplement and don't have any plans to start money out of TSP right away. And other folks are in a spot where they're trying to generate a maximum amount of monthly income, which puts them in a zone where they have to pinpoint how much money do they want to have spinning off of TSP savings and paying them on a monthly basis. How much income or how much money are you expecting to receive from pension and first supplement or Social Security? Those are important questions to answer, because when we're working with folks, the measuring stick is always, or the starting spot is always trying to get you as close to your net monthly income that you used to living on as possible. And in order to do that, you want to have a pretty firm idea of what's going to be the money coming in from the pension, how much money am I realistically going to have coming in from first supplement. That that gives you an informed position to figure out how much you want to have spinning off of TSP savings relative to all the deductions that you pay for while you're working full time that go away at the point of retirement. And then how much market risk are you willing to tolerate? Sometimes people will pinpoint different chunks or different buckets when they're answering that question, or take a little bit slightly more risk on the long-term bucket and mitigate the market risk on the short-term bucket. So it all ties together in terms of a planning strategy. And additional key questions to ask yourself about navigating market volatility going into retirement. You don't want to make emotional decisions, or a lot of times people get themselves into hot water because they'll see market volatility hit, make an emotional decision, take it out of the marketplace, and then get paralyzed trying to figure out when to buy back in. So you always want to ask yourself again, does this align with my retirement timeline, or does this investment decision align with the timing of my plans for overall federal retirement? And am I addressing my income needs, or am I reacting? That's an important one, because it seems like every round of market volatility, there's a decent amount of people that make an emotional reaction, take the money out of the market, and then get paralyzed trying to figure out when to buy back in. And then when you finally do buy back in, if you're buying back in 4/5 of the way through a recovery, then you're even more frustrated because you didn't get a ride that way back up. So the last question on the list is an important one to ask yourself. What's the plan? What's the plan to get the money back into the market after I make this emotional decision, or after I knee-jerk reaction and take it out of the marketplace? And then just a refresher on the strategic approach. Oftentimes people will take one TSP and subdivide it up into two or three different buckets that are all earmarked to do different things at different times. And oftentimes that's pinpointing a short-term bucket for income needs in the next 3 to 5 years, an emergency opportunity bucket, which usually those ones are like house, car, medical, vacation type of withdrawals, and then a long-term bucket as well. So just a refresher on the withdrawal options at your fingertips with TSP at the point of retirement. So it's good to remember that a lump sum or partial payment, that would be like a lump sum or partial payment directly to you, which sometimes people will do that to pay off it's usually a chunk of debt, but getting it paid like directly to checking is an option. You just remember that if you're in that boat, they'll automatically withhold 20% off of the top of that withdrawal for federal taxes if it's getting paid directly from TSP. Second option on the list is a full or partial rollover to a traditional IRA or Roth IRA. That we work with folks rolling money outside of TSP quite a bit. And that's usually whether or not they're looking for, oftentimes they want assistance or things that they can get access to outside of TSP that aren't available inside of the thrift plan. Or in addition to that, a resource of information to work with going through retirement and then life post-retirement as well. And then fixed annuity is another one on the list, but TSP's version of a fixed annuity is like the most plain Jane, plain vanilla version of an annuity that you can get. So you probably wouldn't want to go with that option, even if you were thinking about using a fixed annuity. So tips to consider, additional tips to consider and thoughts to have in the back of your mind. Do you have an adequate amount of emergency opportunity money? That's an important one on the list, because if you have too many eggs in one basket and you're taking monthly income and you need an extra chunk, you always have to account for that so you don't run out of money earlier than you were anticipating. Like I said earlier, try your best not to make emotional knee-jerk or emotional decisions about things. Rebalance allocations as needed, and then evaluate all the other sources of retirement income. I was talking to somebody yesterday that was still eligible to take advantage of the VERA offer, but some of the folks that we've been working with that were in the boat of taking those VERA offers, let's say they're retiring at like 53 or 54, and they weren't eligible to turn on their first supplement until they reached minimum retirement age, which was 57. That put them in a spot where they're trying to figure out how to get enough income at the point of retirement, knowing that there's these income sources are all kicking on in different time intervals. So we had a few clients that pinpointed larger chunk of TSP money to have paid to them for a finite window of time, or to get them past that bridge of retirement to 57 or 59 and a half, knowing that first supplement will start kicking in at 57. And then when 62 rolls around, they'll automatically switch from the first supplement to Social Security. And most of the time, when people are moving from the supplemental payment to Social Security, it's not uncommon for them to see a $500 to $1,000 a month pay bump, because the first supplement just takes into account your FERS service, whereas Social Security indexes all of your earnings for inflation. So any job that you had throughout your entire working, or anytime you had a job where you're contributing to Social Security, that always counts. So, and then just a reminder that when you're shifting to a retiree status, your mind is always programmed to be in accumulation or growth focus while you're working full time. And then you have to train your mind to shifting and thinking about, how am I going to use this money as a retiree, or what are the different income sources, and what are the key variables that are most important to me for income sources going into retirement, and get a little clarity on retirement timing and other income start dates. Like we said earlier, if you're eligible to retire from the federal government on an unreduced pension at this date, but then you've got a first supplement that kicks in 5 or 6 years later, and then Social Security that kicks in a couple years after that, you're not shooting yourself in the foot by using more TSP money in that scenario. You just want to be very specific about what you're doing and strategic about what you're doing. And if you know that these benefits are kicking on at different times, that's nothing to be scared of. It's more having a plan and implementing it and staying true to that plan. And then sequencing of income and withdrawal planning, or focusing on which dollars make the most sense to use in short term. How are those going to be invested? How do I want my medium term bucket to be invested? And then how does the long term money need to be invested? And then, like we said earlier, too, coordinating all the other income sources outside of TSP savings. So oftentimes that's obviously your first pension, first supplement, or Social Security, but sometimes people have assets with spouses or other pensions from spouses' employment. So you start to move on to incorporating all of those into the mix. But using market volatility as an opportunity for a strategic review would be something to take into consideration too. You can't hide from market volatility. You just try your best to mitigate it. So, and have a strategy in mind to address it and move around it, as opposed to just getting blindsided by market volatility. So how do you start an overall retirement strategy? Numero uno on the list, we always emphasize to folks that setting up the first meeting is what we call a fact-finding meeting, where we send you a list of identifying information to gather. And then after the fact finder, we set up a second meeting where we break down, just put together all that together into a written plan for you that gives you options for each piece. So what do I want to do for survivor benefit on first pension? What do I want to do with my FEGLI insurance? How much net monthly income am I looking to get as a retiree? What's the income plan for TSP savings? That's where you sit down and break down all that stuff. And then in subsequent meetings, it's an exercise in reviewing the plan, revising the variables that need to be tweaked, and then implementing that plan, and then making adjustments as life happens after retirement too. So the relationship with our clients doesn't end at the point of retirement. It's just life shifts post retirement from the federal government, and oftentimes the plans need to be adjusted, but that's a good spot to be in. So identifying items of information that you need for the first meeting. Copy of a recent leave-in earnings statement is always important, just because we use that to run that net monthly income comparison, where we can get an idea of what are the deductions that you're paying for now relative to the deductions that go away as a retiree. So oftentimes the net is a lot closer than people think it is, because you have a lot of stuff that you pay for while you're working full time that goes away when you retire. So, and then a copy of any sort of retirement estimate that you've gotten from HR or GRB platform, or every year they update your My Benefits report, which is an important piece of info if you can't get a full-blown retirement estimate. Copy of a recent TSP statement is an important one. Any other investments that you have earmarked for retirement income, so outside IRAs, outside old 401ks, outside Roth IRAs, detail on any life insurance policies in addition to the FEGLI. So that'd be like term insurance, long-term care policies. You just want to know the moving parts, or how far you're into the term and when it's set to expire, or what your conversion options are there. If you haven't taken a look at a Social Security statement, it's good to just run one of those. Just get an idea of the most recent values of Social Security benefits. If you have a divorce decree in the mix, that's an important one to take a second look at. You just want to make sure you don't run into any surprises going into the retirement planning process with a divorce decree. And then any information on spouse's benefits. Eventually, you usually start with the federal employee and then layer spouse's benefits into the mix as well. Any questions, Patty?
There are not any questions. In case you don't know, we have a podcast and a YouTube channel. The Federal Retirement Podcast is on Spotify, Apple, and Amazon. Our YouTube channel is Benchmark Financial Group, Kansas City. Don't forget to like, comment, and subscribe.
Thanks for tuning in, everybody. And if any questions come to mind that we didn't talk about, or you'd like to bounce around some ideas with me, feel free to give me a call, or you can always shoot me an email or submit a request to talk via the website. Like we said, thanks for tuning in, and I hope to talk to you guys in the near future. Thank you.